The year 2026 looms on the horizon, carrying with it a whisper of economic uncertainty that has many people feeling a sense of unease. The term economic bankruptcy is often thrown around, sounding both complex and terrifying. However, we can break this concept down into simpler, more understandable terms. This essay is designed to do just that. What can cause such a widespread problem? Which groups in society are most hurt? List the clear signs everyone should watch for. Most importantly, it will offer practical, actionable steps that individuals, businesses, leaders can take to prepare for and mitigate the potential damage. Understanding the challenge is the very first step toward building a resilient response. At its core, economic bankruptcy happens when a country's entire financial system is unable to meet its obligations. Think of it like a household that can no longer pay its mortgage, credit card bills, other loans. For a nation, this means the government cannot pay back the money it has borrowed from other countries, from its own citizens. It also signifies a severe disruption in the flow of money throughout the economy. Banks might stop lending money to businesses. Businesses, in turn, may not have the cash to pay their employees. This creates a chain reaction of financial distress, where the very mechanics of daily economic life begin to grind to a halt, causing widespread hardship and instability for millions of people. So, why is there a specific focus on the year 2026? The global economy is currently navigating a complex web of interconnected risks that have been building for some time. We are seeing historically high levels of government debt, corporate debt. At the same time, geopolitical tensions are creating uncertainty in international trade and investment. Add to this the increasing frequency of costly climate-related disasters, the lingering economic scars from the recent pandemic, and you have a potent cocktail of potential triggers. Experts worry that these various pressures could converge around 2026, creating a perfect storm where a shock in one area could cascade through the system, leading to a significant financial crisis in one or more major economies. The idea of a country going bankrupt is not just an abstract economic theory. It has very real and painful consequences for ordinary people. When an economy collapses, the value of savings can be wiped out by rapid inflation. The security of a steady job can disappear overnight. The ability to afford basic necessities like food, fuel, housing becomes a daily struggle for countless families. To understand how a nation can find itself on the brink, we must first look at the underlying causes, which often act like dominoes falling one after another. The first and most significant cause is an excessive amount of debt. This applies not just to governments, corporations, individual households. When everyone is borrowing heavily, the entire system becomes fragile. If interest rates suddenly rise to combat inflation, the cost of servicing that debt skyrockets. Lenders may become nervous about getting their money back and decide to stop extending new credit. That can choke off the financial oxygen that businesses and governments need to operate, creating a devastating credit crunch. A second major catalyst is the failure of the banking sector. Banks are the heart of the financial system, taking deposits and making loans. If a large number of borrowers start defaulting, homeowners, businesses, the banks suffer massive losses. Losses can erode a bank's capital, making it insolvent. Fear spreads quickly. The collapse of one major bank can trigger a panic. Depositors rush to withdraw savings. Bank runs can cause a cascade of failures, paralyzing the credit market and halting economic activity. Thirdly, severe external shocks can push a vulnerable economy over the edge. A sudden drop in the price of a country's main export commodity can drastically reduce income from foreign trade. That makes it harder to pay for essential imports and to service foreign currency debts. A related problem is a sharp depreciation of the national currency. If the currency plummets, the cost of imported goods like food and energy soars, fueling inflation and hurting consumers. The central bank might sell off foreign reserves to defend the currency, but if reserves are depleted, the country has few options left. Finally, a confluence of global problems can create a perfect storm no single nation can withstand. Major geopolitical conflict, new pandemic, severe climate events, droughts, floods. When several of these shocks occur in close succession, they can overwhelm a country's ability to cope, tipping it into full-blown economic bankruptcy. It is precisely because the stakes are so high for everyone that this topic matters so much right now. By learning about the potential risks and preparing in a calm, informed manner, we can better protect ourselves, our communities, our collective future from the worst potential outcomes. When an economy teeters on the edge of bankruptcy, the impact is not felt equally across society. The most immediate and severe consequences are borne by ordinary people and families, particularly those with the fewest resources to begin with. Workers in sectors like construction, manufacturing, retail are often the first to lose their jobs. Young people entering the workforce find it nearly impossible to secure their first job, stalling their careers before they even begin. The dream of a stable income and a secure future can evaporate seemingly overnight, replaced by unemployment and financial insecurity for millions of households. Small businesses are exceptionally vulnerable. They have smaller cash reserves and less access to emergency credit. Consumer spending dries up, banks tighten lending standards, and small business owners can't pay their rent suppliers or employees. This leads to a wave of closures and more job losses, tearing at the social fabric of local communities. Savings and retirement funds can be decimated. High inflation erodes the purchasing power of savings. Pension funds and stock market investments can plummet. For retirees and those nearing retirement, this can be catastrophic, forcing them to drastically reduce their standard of living or even return to work if they can find it. The financial security they carefully planned for is pulled out from under them, leaving them in a precarious and stressful position in their later years. Recognizing the early warning signs of an approaching economic crisis is crucial. It can give individuals and policymakers valuable time to prepare. One of the most visible indicators, a rapid, sustained fall in the local currency. International investors losing confidence start selling assets denominated in that currency. That creates a surplus of the currency on the foreign exchange market. A collapsing currency makes imports prohibitively expensive. That fuels domestic inflation, and it erodes ordinary people's savings. A currency in freefall is a flashing red light for the economy. Another alarming sign, distress in the banking sector. Major banks suffering huge losses or needing government bailouts. Banks may impose daily withdrawal limits. Some weaker banks may fail and close their doors. When people can't trust banks or access credit, the system's trust crumbles. A steep, sudden rise in interest rates is also a major red flag. Central banks may hike rates dramatically to fight inflation or stop capital flight. Higher rates make borrowing for business expansion far more expensive. They also make mortgages and car loans much pricier. This spike in borrowing costs acts like a brake on economic activity. It can lead to recession, a rise in corporate bankruptcies, and a sharp increase in unemployment as companies lay off workers. Finally, watch for a convergence of negative macroeconomic data. A sustained rise in unemployment as more companies announce layoffs. Rapidly accelerating inflation, especially for essential goods. A sudden halt in foreign investment or withdrawal of international aid and loans. One sign alone is concerning. Several together strongly indicate a severe economic crisis or move toward economic bankruptcy. In the face of potential economic turmoil, feeling powerless is a common reaction, but there are concrete, practical steps you can take to build a personal financial lifeboat. The first and most fundamental step is to create a cash buffer. This means setting aside a sum of money in an easily accessible savings account reserved strictly for emergencies. Financial experts often recommend having enough to cover 3 to 6 months of essential living expenses, rent or mortgage, utilities, food. Having this cash on hand can provide a critical lifeline if your primary source of income is suddenly lost, giving you time to find new work without falling into immediate financial distress. The second crucial step is to actively manage and reduce personal debt, especially high-interest debt. In a stable economy, carrying debt can be manageable, but during a crisis, it becomes a significant risk. High-interest credit card balances, personal loans can quickly spiral out of control if your income drops or if interest rates rise. Make a clear plan to pay down these debts as aggressively as you can afford to, starting with the one that has the highest interest rate. Reducing your debt load not only frees up your monthly cash flow, but also makes your personal financial situation far more resilient and less vulnerable to external economic shocks. A third proactive measure is to invest in yourself by learning new skills. The job market can change rapidly during an economic downturn. Some industries may shrink while others grow. Enhancing your skill set can make you a more versatile and attractive candidate in a competitive labor market. This doesn't necessarily mean going back to university for a multi-year degree. You can look for affordable online courses, professional certifications, vocational training programs in fields likely to remain in demand, healthcare, technology, skilled trades. Finally, it is wise to review and adjust your household budget with a focus on distinguishing between needs and wants. Track your spending. Cut non-essentials like some subscriptions, dine out less, or choose more affordable entertainment. Just as individuals need to prepare, so too do small business owners who face their own unique set of vulnerabilities in a downturn. The most critical action for any small business is to maintain a rigorous cash flow plan. This involves forecasting your income, forecasting your expenses meticulously for the coming months to understand your exact cash needs. Knowing your burn rate, how much cash you spend each month, is essential. This clarity allows you to identify potential shortfalls early and make adjustments before a crisis hits. A tight grip on cash flow can mean surviving a downturn versus being forced to close your doors when revenue inevitably slows down. For small businesses, another key strategy is to proactively trim non-essential costs. Conduct a thorough review and identify areas to become leaner without sacrificing core quality. This could involve renegotiating contracts, reducing spend on low-return channels, or embracing technology to automate certain tasks. On a national level, governments and public leaders have a profound responsibility to steer the country through turbulent economic waters. One of the most important principles is to act early and decisively. When warning signs appear, policymakers cannot afford to wait. Swift, clear, credible actions calm financial markets and restore confidence. Furthermore, governments must prioritize the protection of their most vulnerable citizens. An economic crisis should not be balanced on the backs of the poor. Strengthen unemployment benefits, food assistance, and direct cash support. Working collaboratively with international partners like the IMF for financial assistance and for technical advice is also a crucial component of a comprehensive and effective national response. In summary, the concept of economic bankruptcy is a serious one, representing a profound breakdown in a country's financial system that can inflict significant pain on its citizens. While the risks pointing toward a potential crisis in or around 2026 are real and should not be ignored, they are not a foregone conclusion. The global economy is a complex system, and its future path is not yet written in stone. The key lies not in fear, but in understanding the dangers, watching for clear warning signs, and taking early, sensible actions at every level of society. For individuals and families, prudent habits, building a cash reserve, reducing high-interest debts, and investing in new skills are empowering actions. For businesses and governments, disciplined cash planning, lean operations, decisive protection of the vulnerable, and international cooperation build resilience. History shows recovery is possible. With calm, consistent steps and smart policies, we can face 2026 and beyond with quiet confidence. I am Ray Montoya, and this is Economics.